Have you ever wondered what futures trading is and how it works? Well, let's dive into it. Futures trading revolves around a financial contract. This contract obligates the buyer to purchase an asset or the seller to sell an asset. But here's the catch. It's all set for a predetermined future date and price. In other words, it's like making a promise today for a transaction that will happen tomorrow. Quite fascinating, isn't it? This mechanism allows investors to speculate on the price movement of the underlying asset. So, in essence, futures trading is a way to mitigate risk or speculate on the price of an asset in the future. Did you know there are different types of futures contracts you can trade? First, we have commodity futures. These contracts deal with physical goods such as gold, oil, or wheat. Traders speculate on the future price of these commodities, hoping to profit from price changes before the contract's delivery date. Next, we have financial futures. These involve non-tangible assets like currencies or government bonds. Traders use these contracts to hedge against potential shifts in financial markets. Lastly, we have index futures. These are tied to stock market indices like the S&P 500. Traders use these contracts to speculate on the overall direction of the market. Whether it's commodities, financial instruments, or indices, there's a futures contract for almost every type of asset. You might be wondering, what's the catch? Well, futures trading comes with its own set of risks and rewards. One of the main risks is the substantial loss potential due to leverage. Leveraging allows for larger position sizes, but it can also magnify losses if the market moves against you. Additionally, futures markets can be incredibly volatile, leading to rapid and significant price changes. On the flip side, these risks bring along potential rewards. High returns can be realized if the market moves in your favor. Plus, futures provide opportunities for hedging, helping to manage exposure to price fluctuations. So, while futures trading can provide significant returns, it's important to understand and manage the associated risks. So, what are the pros and cons of trading futures? Let's start with the pros. Futures trading allows access to a wide array of markets, from commodities to currencies, providing a diversity of investment opportunities. Furthermore, the high leverage means you can control large contract values with a relatively small capital. This can potentially amplify your profits. Moreover, futures can also be used to hedge risk, providing a safety net for volatile market conditions. But with every shiny coin, there's a flip side. The same leverage that can amplify profits can also lead to substantial losses if the market doesn't sway in your favor. Futures trading is complex, requiring a good understanding of market trends and economic indicators. Additionally, it requires a significant amount of capital, limiting its accessibility to the average investor. In conclusion, futures trading can be a powerful tool for seasoned investors, but it's important to weigh the potential gains against the risks before getting started.